this is Mike Mascia, Cadwalader. Thanks for tuning in to Fund Finance Friday Industry Conversations. It was a busy week in the fund finance market with the end of the quarter. Lots of deals got closed Tuesday and Wednesday, but largely business as usual, other than the slightly elevated volume. We've been getting a lot of inquiries about bank capital charges. And since the subscription finance market has been largely risk on for me for the last 15 years, I really haven't done a lot of risk off deals. But I've brought in one of my partners today, Jed Miller, who has. Jed, how you doing?
Hey, I'm doing great. How are you, Mike?
Doing great. Thanks for joining me. Let's start at the top, man. What exactly do we mean when we talk about a capital relief trade?
Yeah, so it probably makes sense just to talk for a minute about what bank regulatory capital is, just very generally, because that will provide some context for what a capital relief trade is. So very generally, right, under Basel III, banks are required to hold regulatory capital against what are called risk-weighted assets on a bank's balance sheet. And generally that regulatory capital is 8% of the the risk-weighted amount of those assets. So assets on a bank's balance sheet can be risk-weighted, and for regulatory capital purposes, very generally, riskier assets have a higher risk amount of risk capital associated with them, or risk capital weighting, and less risky assets have a lower weighting. So these Basel III regulatory capital requirements have been implemented in the US under a federal regulation called Regulation Q, and they've been implemented in the EU under a regulation called the CRR, or Capital Requirements Regulation. So CRTs, or capital relief trades, or credit risk transfer trades, are trades that are effectuated under the applicable capital rules, Regulation Q in the US, or the CRR in Europe or the UK, to reduce regulatory capital that banks have to hold against risk-weighted assets on their balance sheet. CRTs can take different forms, but the general theme that's common to all capital relief trades is that the credit risk associated with risk-weighted assets is transferred in whole or in part to one or more third parties that are generally unaffiliated with the bank.
Great. So let's apply that to subscription facilities. What are the typical capital charges for a subscription facility, and how would a trade reduce them?
So subscription facilities are what are referred to in Regulation Q parlance as what they're called corporate exposures. And corporate exposures generally have a 100% risk weighting associated with them. As I said earlier, capital relief trades can take different forms, but one of the methods that Regulation Q and the federal regulations provide for, one of the methods for obtaining capital relief, is to convert a risk-weighted asset, like a subline or a subscription facility, into a securitization exposure. This can actually result in pretty substantial capital relief for risk-weighted assets, such as subscription facilities. So, for example, a subscription facility portfolio that has a 100% risk weighting, if that portfolio is securitized into sort of two tranches of credit risk, the first tranche of credit risk can be reduced to a 0% risk weighting, and the senior, if it's sold to a third party, and that retained senior tranche of credit risk in the portfolio can be reduced to as little as a 20% risk weighting, provided that the transaction is properly structured. In this regard, it may make sense just to walk through a quick example on our screens. So, right, pre-securitization, in this example, we have a bank that has a $1 billion subscription facility with a 100% risk weighting. And so if the bank has to hold regulatory capital in an amount of equal to 8% of that risk weighting, that results in an $80 million regulatory capital requirement for that $1 billion portfolio. But this example shows that there can be fairly substantial and significant reductions in regulatory capital effectuated through a securitization transaction. So in this example, if you have a junior first loss tranche in that securitization, which represents the lowest part of the capital structure in the securitization transaction, if that, for example, that first loss tranche has $125 million face amount, it would have a 0% risk weighting to the bank if it's transferred to a third party. And then in this example, if there's a senior position of $875 million that's retained by the bank, that isn't, for example, synthetically securitized, that would only have a regulatory capital requirement of $14 million. So in this example, you basically have a $1 billion subscription facility, and you go from having an $80 million capital requirement to a $14 million capital requirement.
So let me ask you a little bit more about their structuring. For the subscription facility deals that you've seen, can you talk a little bit about how they're structured? Does the bank retain the servicing of the underlying portfolio? Who are the likely counterparties for the bank, et cetera?
Yeah, it's a good question. So capital relief trades, and this is kind of irrespective of asset class, whether it's subscription lines or other risk-weighted assets. They can take the form of any securitization, right? So it can be a traditional cash securitization where assets are moved off of the bank's balance sheet into an SPV that issues securities, or in the form of a synthetic securitization that uses a credit derivative to synthetically transfer credit risk to investors in the capital markets. A cash securitization, we've seen less of that in the market for capital relief purposes. The reason for that is that under Regulation Q, the U.S. federal regulation implements these Basel III capital requirements. Regulation Q requires that a bank has to de-recognize and remove from its balance sheet any assets that are being traditionally securitized. Changes in GAAP that occurred about 10 years ago actually made that hard to effectuate, especially if a bank retains, the more rights and control the bank contains over the assets, the harder it is to de-recognize. Traditional securitizations also raise a number of other issues. For example, you actually have to physically move assets, off the bank's balance sheet. You have to set up a new SPV, et cetera. The other way to do this under Regulation Q is to do what's called a synthetic securitization. And so there, again, as I said, you don't actually have to physically move any assets off the balance sheet. You don't have to novate or assign any subscription lines. Instead, all you do is you have a credit default swap, which references the subscription lines, and that synthetically transfers the credit risk associated with the subline portfolio. A synthetic structure, generally is going to involve fewer regulatory issues. And doesn't involve these GAAP issues that I mentioned a minute ago. So it may be a more desirable way to achieve capital relief. I'll also mention that most of the CRT trades we've seen done both in Europe and the US utilize a synthetic structure versus a cash securitization structure. It may make sense just to walk through very quickly sort of a diagram just that shows what a typical securitization structure would look like. So here, this is on our screen, we have an example of this, a synthetic securitization structure. Synthetic securitization structures can either be SPV issued, so you can have a separate SPV that enters into a credit default swap with the bank, or they can be issued by the bank directly. Having the bank issue credit-linked notes directly, which is what we have on our screen right now, is probably going to be cheaper and administratively easier to administer. And will also, also raises fewer regulatory issues that, would be present with, if you use a separate SPV. So here in this example, in the middle of the screen, we have a bank, in a US bank. It's got a portfolio of assets here. It's a subscription facility. What it does is it synthetically tranches up the credit risk for that portfolio. And so for the first loss tranche, right? So in this example, the first 12.5% of losses in the portfolio, those losses are borne by investors in credit-linked notes that are issued by the bank. So the bank will issue credit-linked notes. Those will be corporate direct obligations of the bank. Those credit-linked note holders will be entitled to a coupon, which will be the cost of protection, right, for getting protection on this subordinate piece of this reference portfolio. And to the extent there are any losses in that first loss tranche, credit-linked note holders will basically experience, a resulting or proportionate write-down in the principal balance of their credit-linked notes. The remaining part of the portfolio will remain. The bank will retain credit exposure to that, and so here, none of the assets leave the bank's balance sheet. Everything stays on the bank's balance sheet, but the bank has synthetically transferred credit risk for this first loss tranche to investors in the capital markets.
Who are the typical investors? Are we talking insurance companies or specialty funds, or who are you seeing that understand subscription facilities enough to play on the other side of the trade?
Yeah, look, I think it's really any sophisticated investor that we would see in this the cash securitization market. So I think, we see hedge funds, pension funds, insurance companies, and even other banks. I think one of the reasons investors find this asset class attractive is that, unlike, maybe some more traditional securitization structures, I think investors take comfort from the fact that banks have originated these assets and that they retain them on their balance sheet. And that not only that, but after securitization is complete, the bank continues to retain credit exposure to these assets on albeit on a second loss basis, but it still has exposure to these assets. Another thing I think investors like about these CRT transactions is they're often done on a programmatic basis. So, I think investors feel like banks are incentivized to structure these transactions in a way that they're successful so that they can continue to, close additional CRT transactions in the future.
Yeah, well, we're certainly hearing a fair amount from banks about the impact of their regulatory capital costs on their portfolios. What are you hearing, and what do you forecast for future market activity?
Yeah, so look, historically, there's been more activity in this space in the UK, in Europe, than there has been in the US. I think there's a couple of reasons for that are that, I think European banks have been not as well capitalized as some of their US counterparts. There are also some differences in the EU regulations that may have made it more attractive to execute some of these trades in the past. But look, I mean, there's been a lot of market activity in Europe. There's been a lot of market activity in the UK, and we're seeing an increasing amount of activity in the US. So, recently we saw a regional bank in Texas execute a CRT transaction on mortgage warehouse lines. Banks have, banks are always looking for ways to reduce their regulatory capital. And so to the extent I think banks continue to originate loans and other exposures that have an associated regulatory capital burden, they're going to be looking at this, at these types of transactions as a way to free up capital to deploy in more efficient ways. And as I said, I think that, I think there's a pretty big investor base out there for this product. And I think we'll also start to see not only more of these trades, but more of these trades on a more done on a more diverse range of asset classes. I mean, we've seen them on sublines, but I think we'll see more on sublines. I know we're getting a lot of investor interest in that asset class in particular, but I think we'll also see other asset classes as well.
Great. Well, Jed, thanks so much for joining us. I know this was short. If we can provide more information for anyone who'd be interested, please reach out. Thanks for dialing into Industry Conversations.
The material and information contained in the podcast is for general informational purposes only. Any use of the audio within this podcast without the express consent of Cadwalader is prohibited. Quotes from this podcast may not be used without the express permission of the speaker.